Welcome, everyone, and thank you for joining our webinar today, Winning the War for Bank Deposits, Successful Strategies for Securing and Retaining Deposits. I'm Joanne Pollitt with Cashfac, and I'll be moderating today's session. We do have a full agenda today, packed with a lot of great information to share with you over the next 45 minutes. But before we dive in, I just would like to go over a couple of housekeeping items to make sure everybody's comfortable as we move through the day. As we go through the webinar, if you have any questions, please feel free to ask them via the Ask a Question tab on your screen. And time permitting, we'll address as many of those questions as we can at the end of the discussion today. If we don't have an opportunity to address your questions specifically during the session, don't worry about that. We will follow up with you directly after the webinar. So please go ahead and submit any questions or thoughts you may have via that tab. Also, everybody today will receive an on-demand recording of the webinar once we've completed. So feel free to take notes as you wish, but know that the content will also be available after the session and also will be posted on the Cashfac website for your reference. And our goals today are really twofold. First, we want to share with you some recent research that Datos Insights has put together regarding the importance of deposit growth in commercial banking, as well as some of the strategies that banks are taking to drive growth in the area. And through his research with banks, corporates, and corporate customers, and also fintechs, Enrico will be sharing some of that information in just a moment with you once we go through some introductions. The second thing we want to do that's important today is really share one bank's journey to driving deposit growth through the use of technology. And in this case, by implementing the Cashfac virtual bank technology solution. So I'll be asking Mike some questions after we hear from Enrico to give you some perspectives on what is actually possible and what it may take to achieve that. So with all that said, let me go ahead and introduce my partners for today's discussion. As I said, I'm Joanne Pollitt with Cashfac. I've been in financial services for over 35 years, primarily in the commercial banking space. I've been spent the majority of my career with banks, but also have worked in technology companies and advisory services firms, and most recently came to Cashfac last year from Gartner, where I was a vice president in their commercial banking practice, serving both bank executives and technology providers globally. And I'm happy to be joined today by Mike LaCava, who's an executive advisor to Cashfac, and he comes to us from My Time Advisory, which he recently started following his 40-plus year career in financial services. Mike was formerly the head of the commercial product management at Webster Bank, where he was responsible for developing and implementing the product strategy for the bank. And he spent his first half of his career on the IT side before he moved over to product. So while he's been primarily focused on treasury management and commercial banking, he has led teams at Capital One, Deutsche Bank, Bankers Trust, and First Data. So brings a wealth of information to the conversation today. Also joining us is Enrico Camerinelli. Sorry about that, Enrico. I always stumble. Enrico is a strategic advisor at Datos Insights, where he specializes in commercial banking, cash and trade finance, and payments. And just a few of the many areas of expertise that Enrico brings to the conversation today include APIs, corporate treasury, embedded finance, liquidity management, open banking, trade finance, and virtual accounts. So as I said earlier, we have a full agenda today. So with that, I'm going to turn it over to Enrico to share some of his latest research and insights.
Thank you, Joanne, and nice to be with you and with Mike in today's session. So as you anticipated, I'm going to share some of the findings of my recent research and ongoing research in general on managing bank deposits, but also what is the role of virtual accounts in this very dynamic environment. So I thought of structuring my brief presentation into three major, areas of interest. One is the overall landscape in commercial banking and why deposit growth is important. This will lead to virtual accounts and virtual account management, and I will explain in the course of my presentation how deposit growth ties with virtual accounts. And then based again on the findings of a recent research, what are the key functionalities and requirements for virtual accounts, but how they play an important role in the overall cash management ecosystem. So with that said, the overall environment, you will appreciate that these slides are pretty busy, but this is intentional just because so the attendees will also benefit from the data that, because the short of we don't have that much time, I will not be able to further develop. But in any case, I think that the top left chart is, I would say, validating or confirming what everybody expects, that there's the priority in terms of attracting deposits from corporate clients at banks. And this is a chart that comes from our Corporate Banking Executive Council, and interviewing bankers, so executives in different banks in the US. We see, again, there's no surprise here, that the priority of increasing deposit or attracting deposit is pretty high. What is most important is the other chart, is what are the reasons, what are the drivers for that growth? And while, let's say, if we look at the top part of the chart, that the interest in sort of the drivers for increased deposits is for growing interest rates, also the consequence of recent bank failures or a more challenging economy and pending recession. What I find interesting as an analyst is what is the lowest or the least, let's say, important, if you will, in this analysis. What is the least relevant driver? Not that it's not important, I should correct myself, but the least, let's say, relevant, the one that has the lowest impact. And actually, it's the last one. The increased competition of fintechs offering deposit capabilities is not felt as being a key strategic driver to, let's say, attract deposits. So this means that the fintech presence, once more, is not seen as a threat by banks, but rather as a potential partner. And we will see in the course of my presentation why is it so. But I would say that the bottom line, if you will, or the so what of this first chart is that the reason why banks are interested, or the drivers for banks, or what they're seeing from the corporate clients in terms of increased interest in deposit growth, is not because of a fierce competition coming from fintechs. So that is not the reason. So this again puts the responsibility and the onus on banks. So deposit acquisition is forcing banks to take action, given that it's up to banks. And in this case, I would start from the bottom right chart here. Why are banks in the front line of deposit growth to the eyes of the corporate treasurers? In my research, I always put the treasurer at the front end. First of all, because I come from a corporate background, and also because whether you are, in the case of a fintech provider, whether you are servicing directly corporate clients or you're servicing banks, in either case, or in both cases, you want to know what the end user, in this case, the corporate user, wants. Because if you are to service a bank, you want to know what your bank's clients expect. And in this case, as we see, the reliance of corporate users on banks is very high. So especially when it comes to a deposit taking, the overall relationship with the bank and the credit quality of the bank are the most important elements that corporate users consider. So the go-to is the bank. Of course, we have maybe in the consumer banking space, the role of fintechs that is much more relevant than what we are seeing instead in the corporate space, which is what we care about today. And going to the other, so the top left chart, what are the initiatives that banks are putting in place to respond generally to the overall regional crisis, but also, again, to correspond to those drivers to grow deposits. And if we just look at the top three that were the most voted, again, by the Banking Executive Council members, we see that more focus on client outreach to ease customer concerns, and renewed focus on cash sweep products. Let's say that is more of a technology, if you will, a technical solution. But the third most voted is, again, incentivizing deposits from new customers. So if you take the first and the third element, what I would consider them more putting the bank in the role of an advisor, a trusted advisor to the eyes of the corporate user. So the role of financial institutions is, of course, to provide let's say, the necessary financial instruments, just like we're seeing, cash sweep products. But more importantly, for the end user, is the possibility of relying on the bank in terms of what to do, what steps to take, what to do next. And so, again, the banks are responsible somehow, or expected to provide the necessary answer to the question what to do. And inevitably, we have to get into, let's say, the technology part of the equation. So how can technology be leveraged in order to help attracting deposits? And of course, the first two most voted have to do with data analytics, being able to analyze the expectations of customers, analyzing data. So that has to do, of course, a lot with technology. But in this survey to the Corporate Banking Executive Council members, I also introduced items like virtual accounts. You see self-service virtual accounts and embedded finance that are not necessarily to be considered as technology instruments for deposit acquisition. But you see, especially for virtual accounts management or self-service virtual account management, to reduce bank internal operational costs. So this, I would say, it's a one so what from this finding, is that virtual accounts are there not only considered to be beneficial in increasing, as we will see very soon, customer loyalty, or improving customer experience and benefiting the customer. This is also important for the bank to have internal benefits. And so we see that the use of self-service virtual account management used by the corporate user is also beneficial to the bank, to the point that you see that 29% of the respondents are already doing it, and the remaining, up to almost 90% of the respondents, are very likely or somewhat likely to start considering using virtual accounts in order to improve their relationship in terms of deposit taking with their clients. And so this opens the way, or sort of is a good segue to the second topic that I wanted to present about virtual account management, because virtual account management is tightly connected with winning the war for bank deposits, which is the title of this session. Again, busy slide intentionally, as I said, but because since, as Joanne said, you will have the possibility of viewing again this the recorded session. And so these tabs come from a recent report we call a matrix report that I wrote on virtual account management platforms. Several vendors were analyzed and reviewed, and this report has in the initial section the market trends and the market implications. As you will appreciate, I hope you have already done so in the initial part of my presentation, but throughout the today's session, my role is not only to take the picture or to show the picture, what is the as-is situation, but most importantly, to provide, as I like to say, the so what. Okay, what is the implication of all this? And if you look at the different market trends, the ones that I found more interesting, and also could be controversial if not properly explained, is the concept of virtual accounts generates interest, but a clear definition is still missing. And if we see what are the market implications, use case examples are needed. Okay, I will not read the rest. What does this mean? This means that nobody buys virtual accounts. So the clear definition is missing. Is not because virtual accounts are not important. As we see in the right-hand side of this slide, we see a question. In this case, is part of our annual survey that at Datos we ran across 11 countries to over 1,000 mid and large-sized businesses. So these are questions we ask to corporate users, typically on the financial, financial departments, treasurers. And when we ask specifically, what is your organization's current status regarding the use of virtual accounts, very few said, we don't know what virtual accounts are. Most of them said, we are learning how to apply them to our needs. We are considering to use them in the next 12 months, or we need to know more. So this means that coming back to the market trends, just like another topic, APIs, accounts, application program interfaces. Nobody buys APIs. Users buy what you can do with APIs, and similar with virtual accounts. Nobody wants to buy a virtual account, but what can you do with it? What are the possible uses or use cases? And this is why respondents, almost 1/3 of the respondents said we are learning how to apply them to our needs. Again, the role of the bank to be that strategic advisor is very important. And so what are the key functionalities and requirements and the expected benefits by utilizing virtual accounts? Again, not for the purpose of the virtual account per se, but what can they trigger? What can they generate in terms of usability? And so again, another chart coming from that matrix on virtual account management platforms. And this is really the part where we're looking at the functionality. So the pure technology or features and functions, as you will. And so typically the analysis is looking at these features along 3 major drivers. The minimal requirements, or let's say the table stakes, what you must have as a player if you even want to get into the virtual accounts management business. So I will leave that as something that is a must-have. But the other 2, the competitive differentiators and the next generation features, are the ones where I want to spend just a few words. So the competitive differentiators are those features that really help, in this case, virtual account management platform vendors to win deals. And cloud native and multi-tenant platforms is definitely a key element to win deals. And in terms of next generation features, so something that maybe it's not today even part of RFIs or request for information, but definitely in our expectation will become very soon an integral component and a decision criterion for users is, for instance, the multi-currency virtual account structures, and most importantly, the possibility of running cash flow forecasting using virtual accounts at a transactional level. Again, this is a key, I would say, evidence that the value of virtual accounts is perceived by the users not in terms of just a one-off solution, but rather as part of a more comprehensive and end-to-end proposition in terms of cash management, liquidity management. So virtual accounts are perceived more and more in their value in adding capabilities to maybe already existing solutions, just like cash forecasting, but adding more capabilities, especially if they allow to build these multi-currency virtual account structures. So in terms of just final words, what are we sort of recommending banks to do is when working with solution providers or with fintech providers, make sure that they offer solutions that the bank cannot or doesn't want to build itself. But also, if you look at the 3rd bullet point under the bank's header, is ensure you get from your virtual account management vendor what you offer from an equivalent physical account. So make sure that the features are the same as you were offering it through a physical account. And from the fintech vendor side, and this has to do a lot, corresponds very much with the role of strategic advisor the bank wants to have and is expected to have from the corporate users, is that fintech vendors must structure and make a sales and onboarding support service available to assist your bank client with new corporate clients. What does this mean? Basically, of course, be rich in your functionalities. And the key functionality tab at the left shows what are the major criteria expected, but also have that advisory role. Make sure that you help and support your bank in showing the bigger picture, the use cases, what virtual accounts can do and can offer under a broader perspective of cash and liquidity management strategy. And with that, maybe I've gone a little bit too fast, but I know that we have more time to speak also with Mike on some broader topics that you want to share with us, Joanne.
Great, thanks, Enrico. A lot of information, and I'm hopeful that everybody on the line will be able to drill down into that a little bit more. post-discussion, and obviously reach out to us with any questions you might have as a result of having a chance to look at that in more detail. There were a couple of things that struck me, Enrico, about what you said. One was really the balance, it seemed, of what's important when you were talking about the importance of deposits. The two elements of both the human relationship part of reaching out to clients and even later maintaining that advisory role, coupled with technology. And I think a lot of times when we are talking to organizations, many times they're focused on one or the other. And I think as we start to engage with banks, we're seeing a little bit more of this. There's a level of both that is necessary. And I think from our perspective, the banks that are doing both of those things, understanding their clients, providing those advisory services, really being a partner to their corporate customer, coupling that with the technology are the ones that are winning in the market at this point. And so it's encouraging to hear that, hear your current research, and thanks for sharing that. With that, I'd like to transition a little bit and talk and provide some context around a real bank that actually underwent an initiative to leverage technology to drive their deposit growth strategy. And so Mike has joined us, as I introduced him earlier today, formerly from Webster Bank, where they actually implemented the Cashfac solution a couple of years ago now. And so Mike, if I could ask you just a few questions around sort of that project, how it went, and things that happened as a result of that. But the first question I'd really pose to you is, what really prompted you to implement the solution? What were the main drivers behind your decision to move forward with a virtual account solution?
Sure. Thanks for having me as well, Joanne. I appreciate being here. Yeah, I mean, and in addition to deposit growing, which has always been important, probably a lot more important today than it was when we started. It was still important, but there are a bunch of other key items that I would stress were critical to our business case. And Enrico touched on one, which was self-service, which is extremely key. I've been around this space for quite a long time, and commercial has always lagged behind what we expect in our everyday life as consumers. And so our customers expect to be able to control everything, to do everything at their pace and not at a bank's pace. And when you look at the traditional solutions that were where virtual accounts were held, typically cores as sub-accounts, we never exposed those to customers of a bank. So the ability for us to provide self-service required something new. So that was a key item. A byproduct of self-service is the other thing clients screamed for, which was timeliness, right? The old processes typically required emails, forms, whatever it was, sent in to an operations staff that went at the pace that they could have been hours, could be days to get what they needed to do versus, sort of the immediacy that one would get as a result of self-service. Now, if like us, all the others I'm assuming on the call are looking to grow this sort of business, when you think about trying to grow what was traditional and having to do that with operational staff by itself, what you would find is that it would be very difficult to grow without spending more money on people and not satisfying clients because of the amount of time it took to do it. So when you look at the self-service and the timeliness and you bundle them together, if you really do want to grow, you really do need a solution that's going to support both of them. From a technology perspective, the cloud was important to us. I mean, I think it's important to everybody these days. There are some legacy solutions that require mainframe hosted environments, which tend to be very expensive. We really were interested in not only a cloud environment, but a managed environment as well. And that was a key criteria for us. And I think the last point I'd make here is that we view this as table stakes. It was a critical tool in the toolbox. I always like to look at it that way, whether it was on the technology side or on the product side. I want the sales folks to have everything they need to be able to support the bank and sell the solutions that we have to our customers. And so this was a missing piece that needed to be filled in.
Great, thank you. So self-service, sort of timeliness, and sort of the ability to be able to scale the business were sound like some of the critical factors. Enrico, were there other drivers that you're hearing of from institutions as they start to go down this path?
Yeah, what I find of interest is thinking specifically about virtual accounts. They play very well with another stream of research that I am, it's part of my ongoing research, which is about, enterprise and bank connectivity, or what I like to call ERP banking, so enterprise resource planning banking. So giving the banking experience to the corporate user by running, all banking operations directly from what I like to call the enterprise cockpit. So it could be the ERP system, it could be a treasury management system, even a basic accounting system, but without having to jump from the enterprise system, which is part of the daily activities that a treasurer operates is on that system. But it happens that when you have to go to do some banking transactions, you have to move to another, maybe an online portal. So you need to have a user ID and password. So the possibility that virtual accounts, given their level of granularity, to somehow shadow, if you will, or to somehow correspond to how an enterprise system thinks and operates in terms of GL, general ledger. So up until now, the general ledger, the enterprise systems work based on general ledgers. And then when they transition to a bank account, the bank account is just a big bucket that contains, all different transactions that are pretty much, granular on the enterprise side. But you lose that granularity when you move to, the physical bank account, and then reconciliation becomes a problem. What I find out is the interest that virtual accounts could really create the same level of granularity and make that one-to-one match between the GLs on the enterprise side and, say, a virtual GLs on the banking side. And so once you integrate directly from your from your enterprise system into the bank applications, really you can really enjoy an experience, a ERP banking experience, and without the risk of losing important elements in the reconciliation process.
Yeah, it's interesting that you raised that. I think back to my banking days in the 90s when we were developing cash forecasting solutions and trying to see how we could potentially integrate with our corporate customer systems. And here we are all these years later, and I think it's still one of the challenges that a lot of banks are trying to nail. So as technology evolves, hopefully that's something that we can do to really enable our customers to have a better experience with the bank. So all interesting drivers, but Mike, I'm interested in really understanding what it took to get this done. Sure. It sounds great. There were good reasons to do it, but can you tell us a little bit about the implementation experience? I know we've probably all heard of and unfortunately probably lived through some projects that have gone awry. I'm curious if things went the way you expected or if you had to adjust, rescope, redo things along the way in order to get this up and running.
Sure. I can share a little bit about that. So this actually was pre-merger with Sterling National Bank and Webster. Before that thought even came to play, Sterling was looking to close this gap, in our toolbox. We wound up finding and discovering the Cashfac solution when we weren't satisfied with others. And we were the first bank in the US to do that. So, it's always interesting to go first. And it was, we had a little challenge that I think everybody has dealt with, something called COVID. And so there you go. And everything that we did during this implementation was virtual. We did not even get to see a person from Cashfac in person until after we were done and after it was all clear and safe to be able to do that. So we had all remote meetings. We did everything virtually, all the planning there. They were very receptive to needs and supportive to work with us as a partner. I think that's the key part. And I think partnerships are key. And I think that's a point Enrico has pushed in there, and a point that I would always push. Our approach was minimum viable product, which is the best way to approach things. We set a time frame of 3 to 6 months, post our discovery. And, we were able to accomplish that at that time for the verticals we were interested in and the standard escrow. I know now that window is smaller as a result of that. So folks can thank us for that, but it's more in the 3-month time frame. We also opted for the managed service because we wanted to allow the IT folks in our organization to focus on other things and things where they had the skills to do. And so the managed service that we put into place has been on point, meeting the SLAs. And, despite the fact that, they're a UK vendor pressing into the US and it didn't really matter. 24/7, we've got the support that we needed needed around that. I think the last comment that I'd like to make, and I think this is sort of to your comment you made in the beginning of the question, and that is, I think through all of our careers, we've worked with a lot of vendors, right? And some of the stories we have are good, and some of the stories we have aren't good. I made a decision post-retirement when I was asked to be an executive advisor to help, grow the business and provide feedback on how to do that in the U.S. because of what I experienced. And what I experienced was very good and very different from what I experienced with unfortunately some of the other vendors that I have dealt with in the past. And I think that's an important point. And I think if you stress the point that in the middle of this was COVID, I think it makes it even more impressive. So I think that's the best way for me to answer that question, Joanne.
Great, thank you. And I know one of the things that can often be a challenge for organizations is sort of integration. So, the need to integrate not only with probably your core systems, but sometimes with your customers' back office systems, as Enrico was talking about earlier. Can you talk a little bit about integration and the role that played in terms of, getting to your minimum viable product and, being live within 3 to 6 months?
Sure, I can. I mean, and I think I stressed the integration point, even in a way beyond that, if that's okay. The first point I would make is that, a lot of the integration, to share the information that is needed by a virtual accounts system can be done, in partnership with the IT organization and the vendor, which, clearly was key for what we wanted to do in the minimum viable product. But I think when I look at where we started and sort of where we ended, I think there's a really interesting story, and I think it's an important story, around that. So in addition to the things we envisioned using the product for, along the way came this bank merger, which clearly had us focus in a bit of a different direction, but it also surfaced a client that was looking for a bank that had a virtual account solution and had very significant deposits. And it was in a vertical we hadn't even thought about in the healthcare space. And what wound up happening was they came to us with an approach, and they weren't interested in using any sort of front end solution or anything because they had a back office solution at their disposal already that is invisible to their clients, that does everything that they needed to do. And what they wanted us to do was to be able to integrate to that solution directly, to be able to take the virtual accounts that needed to be created and maintained, to be able to share the data that was needed for their solution in both directions. And the good news was that we were able to do that. And we were able to do that in partnership with the Cashfac team and the experts that were provided to us and that we worked with. And we did it to the satisfaction of the client. I think one of the interesting things is that you can certainly Google it yourself. It's public knowledge at this point. But in January, the bank decided to acquire this particular client, given the synergies in the healthcare space and the opportunities to grow a lot greater deposits. So I think that the point that I would make here is that when you look at what your goal is, you want to make sure you don't shoehorn yourself into a place where you're going to find yourself at a dead end. And I'll make that point again. But the other part of it that I think is extremely important is that these businesses are sticky. I think Enrico talked about, they like to use the word cockpit, ERP, all those good kinds of things. The treasury management business is a sticky business. And if you can integrate with clients, it's a lot more difficult for those clients to move forward because they view you as a partner, and it's significant. It's not just like a consumer making deposits at a bank that they can readily move, for any reason. So I think, that's a key point. And I don't think that anybody should focus purely on, well, am I going to get revenue by charging fees for virtual accounts? I don't think that's the game, to be totally honest with you. The game is all the benefits we talked about before. And I think the game is what I like to call attributable revenue. And what do I mean by that? You're not getting this revenue if you don't have the virtual account management solution. And as a result of you having that solution, you are, and you should demand and get payment business and information reporting business and the other likes from all those good kinds of things. So, as I talk to a lot of others in this space today, I think that, there is a need for people to embrace solutions like this in order to, satisfy, what their customers want. So I think that's the best way I would answer that question, Joanne.
Thank you. So it sounds like, you had the business drivers, you got through the implementation, you realized success as a result of it, and obviously not even in ways you had originally envisioned. So it kind of leads me to wonder a little bit about, you talked earlier about getting up in your minimum viable product from a few sectors in different verticals, and then, the acquisition of this new business. How important is it to have the ability to offer different segments kind of a unique experience? We've been talking about client experience, for years and years now, when we have client experience officers and we have teams of people who are focused exclusively on that. But in terms of sort of this type of offering, how important is that? Does it really matter? If you're in different verticals, is the workflow the same? Is it going to be different? What was your experience, and how do you think about that?
Sure. Now, I think it comes back to the same comment I made about what we're seeing in the generational change of the people moving into the business, or our clients, and what they expect in their life. I mean, I think people expect to see things in the language they expect to see it. So if I'm used to something in a property management space, I want the verbiage to be in that space. If I'm used to it in a legal or law firm space, I want to see, it in that sort of language. And I think that that's important. And I don't mean just in the user experience itself, but I mean, even in how the product behaves and operates, for the actual user. I think that, clearly, when someone's using a solution, it should be that way. But I think we need to go beyond that. You need to think about looking at, as I mentioned before, the automation and avoiding, dead ends. So equally important to the UX is that, you have clients who make their own decisions about tools that they will want to use or how they might want to integrate. Enrico made a point before about APIs, and it's not that, I use APIs, but what do I use them for as an example? And maybe everyone's not ready to do that, but you need to make sure that when you look at solutions, that you have those kinds of interfaces in order to be able to do that, as well as things like embedded banking, embedded finance become, even more important, in this day and age. So it's not solely, and I would say that the language I mean is around the user interface specifically. It's much broader and much more, beyond that. I mean, if we couldn't do the automation, as an example, with this other client who had no interest in seeing the interface, that wouldn't have sold it. I mean, and those of you who are familiar with things like the property management space know that clients pick solutions that aren't your online banking solutions. And if you don't integrate with it, as a bank, you're not in the picture. So I think all these points around that are points that one needs to consider, and, be careful about, looking at the prettiest thing in the window, and think about all of the pieces that you have that are out there. And, we'll continue to help influence and drive things to meet all of these aspects that I just, mentioned.
Yeah, and I would add, if I may, the real importance of say, industry specialization, because the more the bank gives the message, we don't want to sell products, we want to sell solutions, inevitably, the solutions are different depending on the industry segment. So even something, say, as simple as a payment, we all know that the real value of a payment is not, let's say, the transaction per se, but it's the possibility now with, ISO 20022 and other standards, the possibility of adding lots of information and data to a payment. So I've been working for many years in the automotive industry, and the way and the information you collect in a payment in the automotive industry are quite different from the ones you would capture, or you want to capture, if you are a pharmaceutical or biotech company. So this pushes inevitably the need for a bank to, on one side, specialize on an industry segment, because, again, considering the relevance that banks have to the eyes of their corporate clients in terms of, as again said before, strategic advisors, the more the expectation is, okay, now there's this new technology coming up, this new announcement of this, great solution. As a company, as a biotech company, what should I do? Where should I invest? You are my bank. My story. Can you give me an idea? And so that is really important. And this plays a lot with virtual accounts, specifically looking at virtual accounts, because when I've been talking and still talking to corporate treasurers, they say, you know what, we look with interest at the possibility of use cases in virtual account management, not because we want to disrupt and change our existing accounting structures, but because if there is a new product, a new market we have to service, if there is a new area where we want to develop new solutions, that's where we might consider establishing a virtual account structure. But that, again, depends on what information you want to collect, what general ledgers you want to connect to. And that really much depends on what is the vertical in which that company operates. Not the company itself, but its clients, its suppliers, its business partners. And so it becomes very important for a bank to really be specialized in at least a number of those segments.
I think that makes a lot of sense. And I think, as you've both already articulated, the more we meet with banks, the more they're meeting with their clients and able to provide that specialization, I think goes a long way to moving your relationship from that of a banking partner to that of a partner, and somebody that they're relying on and advising, looking to advice for, rather than just product solutions, if you will. I think it's all been interesting. And thank you, Mike, for sharing sort of the experience that Webster Sterling / had gone through as they made their journey through this. If we think a little bit about towards the future, and I know, Enrico, you've touched on this a bit already, can you share some thoughts with the audience about things they should be thinking about so that as they're trying to grow deposits, as they're trying to introduce new solutions like this, to help with that and to just be better partners to their corporate clients, what should they be thinking about that's coming down the pike so that they don't plug a gap in a product offering perhaps today, but actually are positioning themselves to be able to really benefit their customers as well as the organization down the road?
Yeah, well, when it comes to deposit taking, there is a big trend and big attention, especially among U.S. banks, in looking at embedded finance and banking as a service as a way to increase their reach, to possible new clients and therefore increase in deposits. So that is, it's an interesting aspect, and it's definitely part of my ongoing research. We all see now that banking as a service is creating issues, also not banking as a service, but the way that it's being implemented is creating some problems from a regulatory aspect. Because the tendency, the initial sort of, tendency from banks to say, okay, we will partner with these fintechs because they will open, new avenues of deposit taking for us. In principle, is correct, but at the end of the day, the eyes of the regulator are always on the bank license holder. And so where banks are being penalized now is that in the lack of or poor control or loose control on how the fintech partners are managing those financial transactions for which the bank is responsible to the eyes of the regulator. So what I'm hearing is that the use of virtual accounts, again, can help to create that perfect match between how a fintech is managing the accounts on behalf of the bank, and now actually they are being managed. So the bank can have full control and visibility of how its products and services are being offered to the end user by means of this, let's say, fintech intermediary in an embedded finance fashion. So this is one. So what I'm seeing is virtual accounts also being considered like virtual ledgers, enabling a better correspondence and compliance to regulatory requirements when it comes to embedded finance and banking as a service propositions. And the other element, just to close, there are many more, but the other most important, I would say, is the use of virtual accounts helps also smaller banks to be competitive against large incumbents. Because again, with the notion that virtual accounts are not, let's say, standalone products, but they are part of a bigger picture, like enabling a better cash management proposition, then we can consider that smaller banks can start offering sort of cash management as a service. Because they can, first of all, make more internal efficiency, as we've seen in one of those charts I presented before, that the use of virtual accounts can also reduce internal costs at banks, but also allowing them to be closer to the needs of their clients. And so without having a huge infrastructure like large incumbents have. Smaller banks can have that reach out, and using virtual accounts as a way, as Mike correctly was saying, as a way to produce, what did you call it, attributable revenue. I like that term, attributable revenue. So being, the channel, if you will, just like APIs are connectivity channels, virtual accounts can be those kind of channels that allow smaller banks to offer more added value services to the customers without having the complexity and the cost that large incumbents have.
Great, thank you. That's sort of perfect. One of the questions that came through was asking about that. In the effort of watching the clock here, I know we're at time. We will, as I said, make the webcast available to you all after the call. It will also be on our website. If you have any questions, please feel free to reach out to me directly, and I can get them to the appropriate person or answer them myself. And thank you all very much for attending. We hope that this was informative and helpful for you, and we hope you enjoy the rest of your day. Good afternoon.
Thank you.